what I'm saying here is that the demand for natural gas will pick up. And flow-wise, we don't have the natural gas to match that. So I think the only outcome of such a scenario is basically that prices will have to rise again. The signals are telling me to buckle up ahead of the part 2 of the ongoing energy crisis. Welcome to this live edition of Steno Signals. My name is Andreas Steno. I'm the senior market editor here at realvision. And for those of you who watched the realvision daily briefing on Monday, you'll know that I'm very, very focused on energy right now. The reason is that energy drives cross-asset price action. It drives price action in fixed income, it drives price action in other equity sectors, and it drives price action in foreign exchange space. So we simply need to stay on top of the developments in energy space. And I don't think that we've seen the worst part of this price rally in oil, natural gas, diesel, you name it, yet. So let's have a look at the reasons why I hold this view still. To set the scene, I'd like to show you our assumptions for the fourth quarter supply and demand in the oil markets. There is no doubt about the oil market deficit for the fourth quarter. It is just a matter of how big a deficit you pencil in your forecast. All of the big institutions in the oil space have a forecast of a deficit. The biggest deficit is expected by the OPEC Plus group with a deficit of 3 million barrels plus, while the International Energy Authority, a Western institution, predicts a deficit of 1.3 million barrels. I think the reasonable expectation is somewhere in between those two. And based on my demand assumptions, we'll probably get to 102.5 million barrels used per day, while the supply is still stuck below 100 million barrels a day. It is very hard to see any positive supply news right now unless the Saudi Arabians decide to change course. I struggle to see why they should, since they are basically getting everything that they're after right now. They're putting pressure on the Biden administration. They basically want him out. That's my very cynical take on the Saudi Arabian oil policy right now. And the Biden administration is not able to respond since the SPR is running low, and Biden is not willing to use his ammunition 14 months ahead of the election, now that it's running, if not empty, then close to empty, this SPR. So how important is such a deficit of, say, 2 to 2.5 million barrels a day for the price action in oil space? If we look at the empirical evidence, I'd say that a 25 to 30% price spike is still to be expected during the fourth quarter. The chart that I've brought on the sort of relationship between oil markets and the supply deficit is based on more than 20 years of actual data. And it goes to show that a physical deficit in a commodity market is something that leads to a change in the price momentum. We've had a lot of discussions with sparring partners here at my company, and also with members of realvision, whether this is already baked in this story about higher oil prices, because it is relatively evident or visible to right about everyone that there is a deficit in these markets. But the point here is that it is a physical market. We need the barrel of oil to survive. So I'm not sure that this paper discussion on whether everyone is long already matters a whole lot for price action. But if we are to assess the positioning in various paper trades on oil, I'd argue that it is not that heavy. If you look at the chart here on positioning in the oil market, we have a relatively low amount of futures contracts being traded on the long side. One of the reasons is that fewer traders actually report to the CFTC. But still, this does not look out of the ordinary compared to the positioning in 2020, for example, or compared to the positioning in 2017. So I still think that even the paper market could buy into this oil story to a larger extent than what we've already seen. So despite all of the headlines, despite all the discussions on whether this oil rally is over, I simply struggle to see how it can end without supply positive news, and we've frankly not received any for quite a while. On top of this oil story, we also have a story in diesel that we need to track. And diesel is a bit of a headache from a refiner's perspective, as you can see from the next chart. So if we look at crack spreads, a measure of the margins for refiners of refining diesel and gasoline, we have diesel crack spreads at relatively high levels already. That's the light blue line here called gas oil crack spread. The reason is that Russia decided to curb exports of diesel, and that is, among other things, due to a lack of capacity among refiners. Also, locally or regionally in Russia and surrounding countries. So I think you need to remember that, yes, the Russians try to interfere with the European energy prices via this export curb, but it is also due to the refiners' capacity not being large enough locally or regionally to actually ensure that supply keeps up with demand in the region. So this is both an aggressive and a defensive move at the same time. But one thing is certain, it will have price ramifications as long as it's in place. And it means that the diesel price will likely accelerate from the margin perspective relative to the oil price or the raw oil price. If we look at the 3-to-1 crack spread on the same chart, a crack spread assuming twice as much gasoline produced compared to diesel in the refining process, we're towards the low end of the spectrum that we've seen over the past couple of years, meaning that the refiner's margin for producing gasoline is not that elevated at this moment in time. The issue is that we have very low diesel inventories in retail stores or in the retail part of the supply chain in the West. If we look at the DOE diesel inventory data from 2010 and until now, we're stuck in the low part of the range, and we therefore don't have a big inventory to use should this refiners constraint continue. So I'm of the view that refiners are in a very, very positive spot from a margin perspective here, and I'll get back to how we've traded that exact view over the course of this week. There is also an inflation angle to all of this. If you look at the relationship between crack spreads and the CPI in the US, I think the margin increase that we see in diesel space is a worrying sign for inflation ahead. If you use the gas oil crack spread as a predicting variable for the US CPI, say 2-3 months down the road, it looks like we will be back above 4%, maybe even closer to 4.5% in headline inflation. Well, before New Year's, more or less, in US inflation. And this is obviously a headache to the Federal Reserve. But for now, it seems like central banks intend on pausing despite all of these things ongoing in energy space.
Hey, sorry to interrupt again. It's Raoul here from realvision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
The final part of the energy equation, we've touched upon oil and diesel, is the natural gas space. And the natural gas price has not moved a whole lot yet. But if we look at the supply side of natural gas first, we're still receiving 30 to 35% less natural gas day in and day out in Europe relative to pre-invasion levels. Obviously, you need demand to be down almost exactly as much not to create another big price rally. Is demand then down 30 to 35%? almost. So if we move to the next chart, I can show you that the German industry is not using as much energy as it used to, basically because they're producing less. The German industrial production is down on a total basis, but especially if you look at energy-intensive industries such as chemicals, the auto sector, stuff like that. The production is down 27-28% from peak, an outright catastrophe for Germany, but also a sign that we simply do not have the energy to produce the same amount of goods as we did prior to the invasion here in Europe. This is very depressing to watch this chart. And the big issue is, should German activity rebound just a little bit, we don't necessarily have the natural gas, the diesel, and the oil to match that demand from the industrial side of the demand equation. So if we move to the next page, I have a piece of good news and a piece of bad news out of Europe to report from this week. The IFO survey, so basically the German equivalent of the ISM survey in the US, reported of improving orders relative to inventories in all of the cyclical energy-intensive industries through the month of September. We've seen similar trends in the US, and typically when we see orders picking up relative to inventories, we also see activity picking up 2-3 months down the road. And as you can see from the month-over-month part of this table, we have an increase in orders in chemicals. We have it in metal products. We have it in machinery. We have it in motor vehicles. So what I'm saying here is that the demand for natural gas will pick up. And flow-wise, we don't have the natural gas to match that. So I think the only outcome of such a scenario is basically that prices will have to rise again to ensure that the industrial demand will be contained over time. And we run running a natural gas model based on the storage of natural gas, the demand for natural gas, and then a temperature forecast from the climate center. And it is now above 50% again. It actually, at the very recent update, just after this IFO number, jumped another 5-6%. So we're closing in on 60 in this chart. It's the probability of rising natural gas prices. So in other words, we intend on going long natural gas on the back of this story. And it seems like history rhymes here. If we look back to 2022, natural gas also moved after oil. So I have a chart on the pattern from 2022, where you can see in light blue, we have the Henry Hub front-end contract on natural gas in the US versus the Brent oil front-month contract forwarded 55 trading days in time. And we saw that spike in oil prices ahead of the natural gas price last year. And it seems like we're seeing that exact same pattern unfolding this year. So why is that? Well, first of all, the natural gas consumption is just so much more seasonal than the oil consumption, meaning that this story of improving demand side dynamics in the oil space simply spills over to the oil market swifter than it does to the natural gas space, since the natural gas consumption is very heavily tilted towards the winter season. So I think right about everyone will be surprised in natural gas space when we enter, say, October, November, and the demand picks up just as a consequence of seasonals, because we don't have the supply to match it. And therefore, I think both the Henry Hub and the TTF benchmark in Europe will rise from roughly 1st of October and onwards. And it is partially priced into the forward curve, but not to an extent that seems anywhere reminiscent of last year and anywhere sort of fair relative to the demand pickup compared to supply that I'm predicting. So who holds the basket worldwide when energy prices pick up at this pace? First of all, Europe. As you can see from this chart, the European trade balance is essentially driven more or less solely by energy prices, since we are a big net importer here. Therefore, the euro dollar is very, very connected to this story as well. The euro simply sells off when energy prices pick up. When we had those promising numbers out of the German industry, the euro sold off because energy prices picked up. So it is kind of a damned if you do, damned if you don't scenario for Europe, this one. Even if Europe rebounds, it means more negativity in asset pricing due to the rising energy prices. And if we look at Japan, it is basically a damned if you do, damned if you don't part two story. Here we have the liquid natural gas price index versus the trade balance of Japan. As you can see, they're basically glued to each other, meaning that when prices rise, you see a slowdown or an outright deficit in the trade balance of Japan. So therefore, the Japanese yen looks vulnerable, to say the least, as well here. And I've created a heat map as the final thing I want to say before I briefly want to touch upon interest rates as well. The heat map is based on the running beta to the liquid natural gas price index. And as you can see, we have the euro, the sterling, the Japanese yen, the Swedish crown, European currencies or Asian currencies at the top of this leaderboard. And when you're at the top of this leaderboard, when we measure it in US dollar versus something, it basically means that you're at the very bottom of the leaderboard. So Europe, also including the UK, Japan, and those big energy importers, they're stuck in a mess if these price trends continue. We saw a big oil price rally yesterday again. They've calmed down a bit, the energy markets today, but I'm still relatively convinced that we have more in store for the fourth quarter. So that leads me to the questions, why are yields not coming down yet? Well, due to energy. And I think the cocktail that we have right now is very worrying, since if you look at positioning on the first chart on yields here, we have a scenario right now with positioning being long in US Treasuries, both from what I call active money players, so hedge funds, similar kinds of funds, but also from real money players such as pension funds, asset managers, etc. And this is a survey on their positioning relative to what they're usually positioned in. So it means that asset managers have more bonds than usual. It means that pension funds have more bonds than usual. And I know that there is a skewed outcome space in terms of the price return of US 10-year treasuries. In 100 basis points drop in the 10-year yield will give you a much higher return than a 100 basis points increase. But I struggle to see why that 100 basis points drop should arrive anytime soon, given this positioning, first of all. And secondly, I'd like to show you a chart on the so-called impulse from energy markets to the yield curve. There are two ways that this will impact the yield curve. The first chart Brian is showing here is the ISM manufacturing in light blue versus what I call the necessity impulse. So everything needed to produce chemicals, food, energy. And that impulse weakened very materially from June to June. So when in June 23, prices were down 50%, as you can see from the right-hand axis. And the right-hand axis basically measures the input cost for manufacturers. When they have a clear slowdown in input costs, they can raise margins, they can produce more, they can start filling up inventories, they can start filling up orders books. So it basically means that it is easier to increase activity. So manufacturing activity is likely on the up, both in the US, in China, and in Germany now. That is bad news for those hoping for lower bond yields, because it means that the cyclical part of the economy is moving up. The second thing on the next chart is that manufacturing is very, very related to the yield curve shape. This is the same necessity impulse, just measured versus the 2s, 10s in the yield curve. So the spread between 10-year interest rates and 2-year interest rates. And on my calculations, we have another 150 basis points left of this move towards a steeper yield curve. Obviously, the yield curve can move either in the long end or in the short end. But if central banks intend on not moving the short end, and that is essentially what they tell us right now, we will remain at this high level of interest rates for long. Then the long end of the yield curve will have to do the dirty work here, meaning that the 10-year could rise maybe another percent, or 150 basis points from here. Ouch, given where we are at today. So my high conviction trades remain kind of the same. I'd like to switch forward to our portfolio update at the very end of my presentation. And the portfolio update is for the, I don't know, eighth or ninth week running. Very upbeat because we've had this trend more or less spot on. I think outside of the most recent trade that we've put on, we actually have a 100% hit ratio in trades for a couple of months running. That will obviously not continue. But the portfolio update towards the very end of the slide deck here is very positive still. And we have a few updates to provide you with, seen over the course of the last week. We've entered the so-called crack spread. So the ETF covering oil refiners in a spread versus the transportation sector. You could also argue that it makes sense to enter the crack ETF on a standalone basis. But the point here is that refiners are having a party due to high margins, and I think they will get higher. And on the other side of the equation, we have the transportation companies stuck in a situation with higher input costs due to higher fuel costs and weakening demand for everything from traveling to leisure and hospitality, all that. And that allows for a very weak cocktail in transportation with a weaker demand but higher input costs. So it is a spread trade on who's gaining versus who's losing in an energy squeeze in the US equity market. We contemplate going long natural gas as well. We look into how to do it in an orderly fashion. And we also look into the nuclear trade still because with these price momentums in energy space, I think the nuclear case remains interesting, as we've talked about for weeks, if not months, on this show as well. So I think I will leave you with that for this edition of the Steno Signals show. Remember that this is a window into my thinking, and I cannot guarantee that you have the same risk appetite or the same risk horizon as my trading book here. But what I can guarantee is that we will update you every Thursday on a real vision on the trends that we find interesting to trade and talk about in global macro. This was live a bit earlier than usual. We will be back at a normalized time next Thursday. The reason is that I'm en route to the Ryder Cup in Italy in golf. So I'll conclude this show by chanting Europe, Europe, Europe. I hope we will win the Ryder Cup. If not, feel free to throw garbage at me in the chat room for next week's Steno Signals. Thank you for watching out there.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.